Good morning and welcome to the BioSyent Inc. Q2 2015 results presentation. My name is Rene Gorham and I'm the Chairman and CEO of BioSyent. I'm going to start today's presentation with a review of our sales results for the quarter and 6 months ended June 30th. The quarter finished a shade under $3.6 million, 17% ahead of a year ago. And for the 6 months, we reached $6.9 million, which was 25% ahead of the year ago period. I have some comments in the subsequent slides about the variance in growth rates and what is happening in the business and what's driving growth. I'll leave those comments for subsequent slides. So what's driving the growth? We had a record quarter for pharmaceutical shipments, including a record month in June. FeraMAX 150 had a record quarter. That was the second consecutive record quarter for FeraMAX 150. As most investors or shareholders of BioSyent will know, that we've been facing some heightened competitive activity going back into 2014. We've been managing that situation carefully. We did go into to get some specific IMS data. We pulled January through May 31st, and according to IMS, our share of doses in the iron market were up 18% versus 2014. FeraMAX powder grew 18% versus Q2 2014, and Cathogel units were up 26% versus Q2 of 2014. Cathogel is now used in over 196 hospitals in Canada. That number continues to grow quarter over quarter. In the quarter, we launched a significant direct-to-patient marketing programs for both RepaGyn and FeraMAX. In the case of RepaGyn, this has led to month-over-month shipment to pharmacy growth of greater than 13% and measured over a number of months. We've seen this track all the way from March into July. In the case of FeraMAX, that has led to the record monthly volume that we've had now in 6 consecutive months. I'll speak a little bit about that in a moment. For RepaGyn, we see that the run rate with the 13% month-over-month growth, we see that business is on track now to double in less than 6 months. It puts it on a strong footing, in line with our expectations for growth. It's not that we're surprised by this, but we're pleased to see it. Gives us reason to believe that the brand could ultimately get to a peak penetration that would exceed the expectation when we originally did the in-licensing transaction. Also during the quarter, we increased our line of credit with the Royal Bank of Canada to $1.55 million, primarily to support foreign exchange transactions. For those of you that have been following us for a fair period of time, you'll know that we're quite pleased with the fact that we've been operating our business on a debt-free basis, had no need for receivables financing. We increased the line really to support foreign currency transactions. So that line went from $500,000 to $1.55 million. And in a couple of slides, you'll see a snapshot of our balance sheet. We don't use the credit line for what I'd call traditional uses. We put that new line to work by increasing our forward covers to mitigate the deterioration of the Canadian dollar. You'd have to be living on an island, absent any information about what's going on in the market with the Canadian dollar, to not know that it's been going down strongly, I guess, since about halfway through last year. We have now covered ourselves right through 2016 at rates that are significantly below the current USD CAD exchange rate. This is consistent with what we did in 2014, where we locked in the entire year of 2015 at the USD requirements at 109, and compare that to today's rate, or right around this time in the beginning of August, of about 1.3. This is something that investors don't always pay attention to in respect to our business. We're essentially a net importer. We look for products that are unique and differentiated, and we find them primarily outside of Canada. Most of our goods are sourced outside of Canada. We do have some contract manufacturing in Canada in Canadian dollars. We mostly deal or purchase in USD and in Euro, and manage that situation with foreign currency very carefully. So subsequent to the quarter end, we shipped a large FeraMAX 150 order, and you'd wonder, well, why would we spend any time talking about it? And it's because it's had a distorting effect on our results in the second quarter, and will have correspondingly positive distortion in our results for the third quarter. So in the first quarter of this year, we received a repeat order for FairMax 150 from a customer that we've been doing business now with for a couple of years. That Q1 order was requested for Q2 shipping. We had the product manufactured, had it packaged and ready to go for export on the loading dock, and our customer ran into some documentation and importation issues. So that large order was not shipped in the second quarter and slipped into the third quarter. And it's significant enough that I wanted to have some comments on it to make sure that people have all of the information of what's happening in our business. This order, if it had been added to our YTD June 30th numbers, would have resulted in $7.5 million in total company sales, which would be 36% ahead of year ago. And the second quarter itself would have been 37% ahead of 2014. And if you just looked at our pharma business on its own, pharma sales would have been just a shade under 4 million, plus 37 versus the prior year corresponding. Important and certainly noteworthy, we do with that same customer have 2 additional orders, in this case for FairMax powder. We've already shipped that customer FairMax powder. That did occur in the second quarter. We have subsequent orders for that same product in Q3 and another for Q4 shipping. Also subsequent to the quarter end, I want to just talk a little bit about kind of top line sales results on an overall basis. So I think I mentioned that we had a strong June. We've now had our first 2 consecutive months in the company with sales above $1.5 million. So that was June followed by July. It doesn't take a brilliant mathematician to run that number out beyond $4.5 million for Q3. I'll leave it at that. I won't go into any more detail there, but that puts us on a strong path and kind of in line with where we see the business moving through the balance of the year. RepaGyn itself had a record month in July. It was a significant jump. We measure these records, or how we do, on a month-to-month basis based on what we invoice, which of course is what we report in sales. But we do measure as well secondary sales, that is sales by wholesalers to the pharmacy, and that's what I referenced before about the 13% or greater than 13% month-over-month growth rate for RepaGyn. It was no surprise to us that seeing that we had a record in July. FairMax 150 followed a June record month by another record in July. We've continued to work on new product sourcing opportunities and have committed to additional product sourcing resources in commitment to increase headcount to work on the deal flow that we've got, which is still significant. Those that have been following us for some time are familiar with this chart outlining our pharmaceutical product sales by quarter. This has been modified to just show you the last 20 months. You'll see that with one exception, Q4 of 14, consistent, steady flow from bottom left to top right. Pharma sales reached 3.33 million in Q2 of 2015. With the addition of that large international order that slipped from Q2 to Q3, you'd see that would have been the largest quarter-over-quarter growth that we would have experienced, certainly in percentage terms, since Q2 of 2014. Overall, in actual shipments, Q2 2015 versus 14 was up 25% in pharma. On an EBITDA basis, earnings before interest, tax, depreciation, and amortization stayed in line with how we've been performing on the top line. And this really speaks to kind of our ongoing disciplined approach to managing the business for profit as we go forward. EBITDA was up 31% on a 6-month basis. That's to 2.49 million. For the quarter, it was just under 1.8 million, relatively flat to Q2 of 2014. I've already spoken about some of the factors that it would have affected that. On a net income after tax basis, it would look very similar to what you saw for the EBITDA line. Net income after tax relatively flat for the quarter and up 30% on a year-to-date basis, 6 months, 1.8 million versus 1.4 million in 2014. When you are tracking our history, I know that you're probably not looking too far back, but if in case you do, if you're looking back to 2011, 2012, we were not paying tax at that time. So you're going on this chart here, the 2012 year is not comparing apples to apples. Quick look at our balance sheet. This is a snapshot of the balance sheet, not obviously the actual balance sheet. A couple things I'd like to point out. One is an inventory build from March 31st to June 30th. You'll see roughly $500,000 in inventory build. We had a temporary factory shutdown for FeraMax, just regular scheduled activity. With a product that's that large and growing, we don't want to be out of stock, so we loaded up towards the end of the quarter. We also had that large order for that international customer, and in combination that drove our inventory to $2.2 million. You'll see also that we've highlighted our cash equivalents position. So on June 30th, we ended with just under $7.5 million in cash and cash equivalents and short-term investments. That's up from $6.7 million on March 31st. It's worth just noting how that's kind of trended from December 31st. I'd like to draw your attention down below under current liabilities. In the December 31st, 2014 period, we had an income tax payable amount that was $1.067 million. That tax was paid in the first quarter and would have had a corresponding reduction in our cash position. Now that that's behind us, you see that our cash position is growing, and that's kind of commensurate with our increase in earnings. Our working capital, which we obviously keep an eye on, is up 24% from December 31st, 2014. Once again, we've come through another quarter aligned with our approach, which is we have no debt at this time, neither long or short term. So I made reference earlier to operating expenses. So this chart talks about our quarter and 6 months ended June 30th. So I'm going to first talk the 6-month number and then come back to the quarter. On a 6-month basis, you see that our selling and marketing expense was up 35% versus a year ago. G&A up only 6%, and total operating expenses up 21%. So this compares favorably with a revenue increase of 25%. It's consistent with our disciplined management approach that we've been exercising now for years in building a solid, profitable, growing business. In the quarter, Q2 versus 15 versus 14, you'll see quite a sharp increase in selling and marketing for 49%. So we had some programs that I referred to earlier that were targeted to FeraMax and RepaGyn patients that ramped up towards the end of the first quarter and mostly ran through the second quarter. And so we had some additional hires, which I spoke to in my comments after Q1. We hired some sales personnel for our new hospital products division. Those people were kind of second half of March hires. They would have come into the selling and marketing expense line as well. Overall, the 6-month numbers are kind of in line with our plan and what our expectation was. In G&A, we've added additional resources in supply chain and finance to make sure that we're properly supporting a growing business. Overall, for the quarter, our OPEX was up 38%. So the important takeaway here is that we're investing in what drives the business, and that is product promotion. Our earnings per share for the 12 months ended June 30th were 25 cents. So for the quarter, Q2 2015, 6 cents. That's no surprise based on the net income after tax slide I showed you a few minutes ago, in line with what it was in Q2 2014. That 25 cents is 39% ahead of Q2 2014 12 months ending. So the same comparable period of 18 cents. This is in line with our plan and really our long-term internal target of growing at or above 25% over the long term. The last slide I wanted to speak to was our average return on equity. Normally this is a calculation that's done on an annual basis. We've shown you this from 2010 through 2014 on an annual basis. The 2015 portion is calculated using data for the first 6 months of the year and then annualizing that. So It's a bit of a hybridized calculation, but you see that our ROE at our current rate is still a fairly solid 40%. And we see with what's happening in our business that we feel comfortable that we're going to be able to deliver to shareholders and investors an above average, a well above average return on investment. This brings me to the end of today's presentation. I wanted to thank you for your continued interest and support in what we're doing at BioSyent. We've got a really motivated, hardworking team of people, and they're making progress on many fronts. I just wanted to remind you of some resources if you wanted to get some more information on us. BioSyent.com is our corporate website. SEDAR is where all statutory filings go, and then we've got obviously some product websites. Once again, thanks very much, and we look forward to reporting our continued progress to you in the coming months.